Hi, my name's Glenn Fairbairn. I'm a wealth advisor, director and co-chair of the Hewison Private Wealth Investment Committee. The investment committee consists of 4 members. We meet on a weekly basis, and really our role is to undertake due diligence on every investment that our advisors are recommending to our clients. The criteria that we follow to select investments is very much around, firstly, understanding the investment, but also making sure that our clients' capital is always protected. And that's probably the number one thing that we look at whenever we start undertaking due diligence for any investment. Is our client's capital going to be protected? Do we understand the investment, and what sort of outcomes are we hoping for, and what are we expecting? The main point of difference at Hewison Private Wealth is that because we're completely independent, we don't have any affiliations with any other organisations, but also because we manage our client portfolios completely off administration platforms, it gives us a great degree of choice as to what our clients can invest in. So we're not restricted, we're not hamstrung as to what sorts of assets we can recommend to our clients. So as a result of that, it does enable us to bring solutions to our clients that a lot of our peers can't. An example of an investment opportunity that is quite specific to our clients, and perhaps that a lot of other advisors don't have access to, would be property syndications. We've been able to develop a number of long-term relationships with groups who have bought us quite bespoke, quite high-quality property opportunities, and because we do invest off-platform, we've got complete, I suppose, access to those sorts of opportunities, and it's enabled our clients to get access to property assets that they perhaps otherwise would be unable to, either because they don't have the level of capital required to purchase those sorts of assets, or they just don't have access to sophisticated assets within that asset allocation or within property. So through these syndications, our clients have been able to invest in high quality office, industrial, hotels, other forms of commercial assets where they've actually got complete visibility as to what they're investing in. So there's a fair degree of tangibility around what assets do they own, who are the tenants, what are the rental lease terms, and what outcomes they're expected to achieve by holding those sorts of assets. Throughout any market environment, there's always uncertainty, and markets are very dynamic, so they can move in very different directions very, very quickly. And it's almost impossible to predict what the outcome of investment is going to be in the short term. So at Hewison Private Wealth, we do have a preference to invest in assets that have predictable cash flow, so predictable income. Through our experience, what we found is that good quality investments, although their asset values may fluctuate, that the income's quite predictable. So whenever we're constructing portfolios for clients, we do prefer to invest in direct assets, whether that's property or direct equities, because although we can't predict the total return outcome in the short term, at least we've got a great degree of confidence and certainty around what the income's going to be. So it just gives our clients peace of mind that they can live their lives and manage their day-to-day budgets, because they can have a great degree of confidence as to what income is going to be generated by their investments, and therefore aren't forced to sell good assets at inopportune times. As co-chair of the investment committee, our role is to do due diligence on new investments, but also monitor existing investments. We meet weekly, undertake a lot of research and monitoring in relation to the investments that our advisors are already recommending to our clients. So specifically with Australian company shares, that's something that needs to be monitored on an ongoing basis. But having said that, we make long-term decisions. So we're not looking at trading portfolios on a high frequency basis. So companies that we have on our approved product list that we want our advisors to recommend to clients, that advice is very much over a long-term time frame. But then with new opportunities, depending on what that asset is, if it's property or if it's a fixed income opportunity, we do prefer to do a lot of the hard work at the beginning, because as I said, we really want to take that long-term view with an asset class. So by doing that hard work at the beginning, we can be more comfortable that we're making the right decision for our clients, and therefore be comfortable holding that asset for a long period of time. I've been co-chair of the investment committee for almost 10 years, and I think the biggest shift that we've seen in an industry is with exchange traded funds, so lower cost options for investors. Whether that's the best outcome for every client, that's the question I suppose that remains unanswered. From our perspective, although that's been a massive shift, because there's obviously cost pressures and advisors and investors want to get the best net outcome for their clients. But from our perspective, what we like is visibility. We like investing in real assets. So assets that we can see, we can predict outcomes, and we just have greater visibility as to what we're actually investing in on behalf of our clients. As a wealth advisor, our role is to construct and build portfolios that can achieve outcomes for our clients. And I think that's a real point of difference for us, is that every portfolio that we build for our clients is very tailored to what it is that they need to achieve from that portfolio. And I think that quite often within our industry, there's a big disconnect between the individual's objectives and what the portfolio is trying to achieve. And with those portfolios that are constructed without having any understanding of the objective, there can be quite a large mismatch, in that quite often there's a large emphasis on total return as opposed to what risk is being taken to achieve that return, and is that portfolio still suitable for that particular client. So really the way that we construct portfolios is reverse engineering, so looking at what's the outcome that we want to achieve, and then developing a portfolio that can achieve that outcome with the minimum level of risk. There's probably too much of an emphasis placed on what return has been generated by a specific investment option. And I think that in particular in the superannuation industry, quite often every year we see what results varying super funds have generated, but we don't see what risk has been taken in order to achieve those returns. And we always talk to clients about the relationship between risk and return, and you really can't look at either one in isolation because each one can impact the other. So generally speaking, if you crave a higher return, then you need to take a higher level of risk. And I think it's just important that individuals understand that that is the case, and they do go hand in hand. Otherwise you can have a great mismatch between what you think you're investing in and what you're comfortable investing in compared to what you are actually investing in. Look, I think the future of Hewison Private Wealth isn't too different to what our past has been. It's always been focused on helping our clients, building strong relationships, and really helping them manage the different stages of their life, whether it's early on in life where they're just starting out, getting a job, perhaps repaying debt, moving through life, having families, continuing to build wealth and preparing for retirement. So our business is all about building relationships and helping our clients manage their way through their lives and through varying economic climates.